am.
Okay, so let's begin. So I'll quickly read through the question and then we'll begin with the computations. The question reads, Quicksilver Paints Limited is reviewing operations for the year 2023. The company operates standard marginal costing system and manufactures one product, WaterGuard, for which the following standard revenue and cost data per unit of product is available. The selling price is 12 kwacha. We have direct material A, direct material B, and we have direct labor. We have fixed production overheads for the 3 month period. We're expected to be 62,500 kwacha. The budgeted production and sales for the 3 month were 50,000 units of product water gas. Actual data for the 3 month period was as follows. Sales and production, 48,000 units of water guard were produced and sold for 580,800 kwacha. Direct material A, 121,951 kilograms were used at a cost of 200,000 kwacha. Direct material B, 67,200 kgs were used at a cost of 84,000 kwacha. And then we have the direct labor here. And then what they want, okay, this is what they want. So firstly, we'll start with A, and then afterwards, we'll go to B. Okay,
Okay.
yeah.
Yeah.
All right. So this is variances, okay? This is a variances. So it being variances, we know that we are practically making comparisons. We have two
Yes.
things here. We have the actual and we have a budget. Okay, and we are comparing the budget and the actual. What they
Yes.
want here is the difference. Okay, the difference
Yeah.
between the actual and the budget. Let me give you an example. Let me just explain something. Like for instance, on the first one, when they say sales volume variance, imagine they ask you this question. They say sales volume variance, and they say sales volume contribution variance. Do you think there's a difference between the two? And what do you think the difference is? Because yes, there is a difference, but what is the difference?
Let's see. Okay, maybe you help me on that one to differentiate the two.
Okay, so the way it is that the sales volume variance, we are basically looking at the difference in our sales units. Usually, because every single time you're actually making a variance, especially if it's in units, every single time you make the variance in units, you value it later on. So if we're talking about a sales volume variance, we're just finding the difference in the actual and budgeted units. Like for instance, if they want a sales volume variance, we check out our sales. Our actual sales are 48,000. But what's our budgeted sales? What's our
Okay.
budgeted sales? Our budgeted sales is 50,000. So we have an adverse of 2,000. Okay,
2000,
if they
yes.
were to if they were to ask a sales volume variance, we'll get the 2,000 and the valuation will be we'll get the 2,000 units and multiply it by the selling price.
Okay.
Okay, but
Yes.
if they want a sales volume contribution variance, this is what the difference is. You know what contribution is? They don't want the sales volume variance just like that. They don't want the sales value as the valuation, but they are practically talking to us. They're telling us that after you find the variance, the sales volume variance, value it using its contribution. So we are going to use the standard contribution, which is the budgeted contribution. Are you familiar with what contribution is?
No.
Okay, all right. So basically, what this means is that I'll have to take you into details to make
Yes.
variances way easy. Let me just let's see. Hopefully, we'll have enough time to finish this question. But now I'm forced to explain a number of things.
Exactly.
Yeah. Let's see. I just want to open Excel. Okay. Right. Let me just explain something. Okay. So we know a variance is a difference, right? A
Yeah.
variance is a difference.
Difference.
Perfect. We know a variance is a difference.
Difference.
Okay. Um, I'm checking the time to see if we manage to finish this question. Okay. We know a variance is a difference. I just like typing what I'm doing. Okay, so we know a variance is a difference. Variance, difference. It comes from the word vary. When
Yeah.
things vary, it means they are different. Okay,
Different.
so a
Yes.
variance is a difference. A difference between what? A difference between the budget and the actual. You know, when you're doing, let's say you work in a business, you work in a company, you're doing forecasting, okay? You do your
Yes.
forecast. You're like, next year, we're in 2025, next year, I'm going to spend 2,000 kwacha on stationery. And then
Yes.
when the time comes, instead you spend 3,000 kwacha. If you compare
Yes.
your budget of 2,000 kwacha and your actual of 3,000 kwacha, the difference is what we call a variance. But the specific name of the variance, it's actually the specific name of the variance is actually determined by the type of financial element that is. I'll give you an example. If we talk about costs, and if we are more specific, we talk about fixed costs, it will be a fixed
Yes.
cost variance. Okay,
Yes.
but if we talk about variable cost, it will be a variable production variance. Okay, if we
Okay.
talk about sales, it's a sales variance. Okay, if we talk about the
Okay.
sales value, we are looking at the sales price variance. But if we talk about the units that we are selling, our products, then we are focusing on the sales volume variance. Volume and units mean the same exact thing. And there's
Okay.
an assumption in management accounting, okay? There's one main assumption in management accounting that you probably find in costing accounting as well. The assumption is every single time we're making a budget, our assumption is our sales volume is always the same as our production. We
Okay.
always sell everything that we produce. Have you noticed that in our question, if I were to open the question again, you'll find the sales and production are 48,000. Okay?
Yes.
Yeah. And then they're saying budgeted production and sales for the 3 month we are 50,000. Have you seen that they're using one figure for the two? 50,000. The assumption is they'll sell everything. Like I produce 48,000, I am selling 48,000 again. There's nothing like I don't sell something. I'm selling everything. That's just the
Everything.
way it is.
Yes.
Yeah,
Okay.
but that's an assumption. That's not like that's not really factual. That's not something that happens in our day-to-day life. But that's the way management accounting is. Okay.
Yeah.
So let me start again. A variance is a difference. Okay. Now let's talk
Yes.
about. Let me just give you a simple cost card. A simple cost card. A cost card. When you talk about a standard, have you ever seen a question that's asking for a standard sheet or a standard cost card?
Yeah. Though we did it with some colleagues, I was just following.
Okay. So you're familiar with it?
Yeah. A bit.
Okay, so the word standard means budget. Okay, when we say something is standardized or something is a standard, we are practically saying it's a budget. It's a budgeted amount. So when they
Okay.
want a standard sheet or a standard cost card, they practically want you to give them a cost card per unit as per their budget. They want to know
Okay.
the total cost as per their budget per unit.
Okay.
Okay,
Yes.
so imagine this. Imagine this. Uh, we want to sell 5,000 units. Of a certain product. Let's say I'll name this product A. Okay, and then our sales and our sales and production are 5,000. So we have
Yes.
product A that we produce ourselves, we manufacture this particular product ourselves, and we sell this particular product ourselves. And
Yes.
every month, let's say this month, let's say we're in April. So let's say this is April. So in April, we sell and we produce 5,000. We produce 5,000 and we sell out everything. Okay.
Yes.
The selling price of this product, the selling price of this product is the budgeted selling price. Okay, let me say budgeted, let me be more specific. Budgeted, the budgeted selling price. So I just want to check if someone, I bet they'll show me some notification. Okay, the budgeted selling price, the budgeted selling price is, let's say, 20 kwacha. Okay, we sell this
Yes.
product at 20 kwacha.
Pretty much.
we
Yeah.
do we do incur costs when running this particular business. Okay, every single
Yes.
time we want to produce this thing, we do incur costs. So let's say we incur labor costs. Okay, let's say we incur labor cost of 8 kwacha, and then
Yes.
we have a material cost of of 5 kwacha,
Yes.
and then we have specific variable costs. So let's say we have specific variable costs of, let's say, I'll say 2 kwacha per unit. This is per unit, by the way.
Yes.
Okay. So all these three are known as variable costs. Okay. All these
Yeah.
three are known as variable costs. You know what a variable cost? A variable cost is a cost that moves hand in hand with production. Okay?
Okay.
A variable cost
Yes.
is a cost that changes with the level of production. The more our production increases, the more the cost increases. Okay? A
Increases.
fixed cost
Yes.
is the opposite. Okay? A fixed cost is a cost that is not affected by production. So right now
Okay.
I'm practically just focusing on variable cost because what
Yes.
I need you to understand is contribution.
Vision. Yes.
And when we talk about contribution, here we're not talking about fixed costs. No, we're not talking about fixed costs. We are practically just talking about variable costs.
Cost.
Okay?
Yes. Yes.
Yes. I
Okay.
know you've probably heard the term prime cost as well, especially on throughput accounting.
Okay. Let me just take note of that. Contribution.
Okay,
Okay.
so a prime cost. Okay, so a prime cost. If okay, let me just label them. Let's say a prime cost. I want you to even see the difference because you probably find this on throughput accounting as well. Since we are here looking at costs, we might as well talk about them. So a prime cost. So if we talk about direct labor and material, these are prime costs.
Okay.
Okay. Um, Yeah, okay, let me do this. Let me just focus on the variable because I want that's throughput accounting. I want to link here. I just want to explain the contribution. Okay, let me
Yes.
just say
Okay.
let me just say these are variable costs. Okay, since I've just grouped them in as fixed costs and variable costs. So these are variable costs, the costs that are actually affected by the changes in production. The more our
Production.
production
Yes.
increases, the more this particular cost increase. They don't increase per
Yes.
unit; they increase because the units increase. Okay,
Yeah.
so that's the way it is. So now what is contribution? Let's say we make a simple standard card for this. Our selling price, our selling price will be 20. Okay? We change
Yeah.
all this to what? Our selling price will be 20.
20.
And then
Yes.
our labor, which is direct labor, okay?
Yes.
We can have indirect labor. That's why I'm trying to be more specific. I'm talking about the direct labor here, the variable labor. So
Labor. Yes.
yeah, we have labor, which is 8 kwacha. We
Okay.
have material. The material here is the direct material. So
Yes.
which is 5 kwacha. And then we have other variable overheads.
Okay.
When you talk, do you know what other variable overheads are, or basically specific variable costs?
Let's say on variable costs. Let's say if we are producing a certain product, then it happened that let me see how can I put it. Okay, Mr. Ronald.
Yes, sir.
Okay, maybe just you help me on this one. Variable cost. The way I've come to understand variable cost is, let's say we are producing a certain product, then it
Yes,
happened
sir.
that then it happened that we want to increase on the units to produce. Then we get to hire some maybe part-time casual workers to help on the addition of to help on the addition of the extra production that we want to increase by. Then we are going to put that wage we are paying to the cashiers that have been engaged, and it will be treated as a variable cost under direct labor. I think that's how I understand that one.
Okay. All right. So yeah, that's actually variable cost in general. I
Yeah,
think you are defining all variable costs, costs that move hand in hand with production.
production.
Okay.
Yeah.
Yeah. Okay. But I wanted this other variable. Since we have labor here, we know labor cost, the direct labor. You probably give
Yes.
employees, or the ones who get per hour or per
Yeah.
unit they produce, and then material cost, the number of units you need, the cost per material that you need for each unit, and then
Yes.
here the other variable overheads. So the other variable overheads, these are also these. If you were to check your book, your manual, or your past papers, you'll find they like using words like other variable overheads, variable production overheads, or specific variable cost, or specific variable overheads. So what they're talking
Okay.
about here are variable production overheads that are neither labor nor material costs, but they are considered to be variable.
Okay.
Since in every business, in every manufacturing business, trust me, they have more variable cost than just labor and material. So what they do, they specify on labor, they're like labor, direct labor cost. And then they specify on material, they're like direct material cost. And then
Yes.
on other variable costs, they just group them. They're like, okay, we have this variable cost, and then you sum them together, and then these are the other variable costs.
Okay.
Yes. So a specific variable cost or other variable cost is practically a consolidated amount of variable costs that are not specified.
Okay.
Yes. Okay. So if we get our total variable cost here is 15 kwacha. Okay. And
Yeah. Yeah.
also the variable cost is also known as a marginal cost. A variable cost is also known as a marginal cost.
Marginal
So
cost.
when we talk about contribution, we are looking at marginal costing principles. Okay. We are not talking
Okay.
about absorption. Okay. We are not talking about absorption here. We are talking about marginal costing principles. Contribution relates to marginal costing principles. All right.
Yes.
So our total variable cost is also known as our marginal cost. If we look at marginal costing principles, we just subtract our variable cost from our selling price to get our contribution. Okay.
Yes.
So
Yes.
here we subtract, we have this, the total variable cost, which is 15. And then
Yes.
here, if we subtract the total variable cost from the selling price, what we will get is the contribution
Oh.
per unit.
Yes. Okay.
Okay. So what is the contribution per unit? The contribution per unit is the difference, just sum this up. The contribution per unit is the difference between, let me just pull this to,
Between the
yeah,
variance
the
variable
I12 each. Okay, so the contribution per unit is the difference between the selling price of a product and
Yes.
the variable cost of that product. Okay, between
Okay.
the selling price of a product and the variable cost of that particular product. Now let me relate this to our question. Okay, let me relate this to our
Yes.
question so that it adds more meaning. So
Yes.
before we actually go to our question, let's make a similar question using our data, using the information that we have right now on our screen. Okay.
Yes.
So here we have sales of 5,000 units. Okay. This is our budgeted information. What if I just
Yes.
make our actual information? I'll just make up actual data. I'll just make up actual data. Okay. So made up here, but it will help us understand this. All right.
Yes.
So our actual data, let's say instead of us selling and producing 5,000, our sales and production are now 4,500 units.
Yes. Okay.
Okay. This is our sales. Okay, and then our revenue, our revenue is 20. Okay, I just want to estimate the 20 quarter. I just want something that's more realistic.
Okay, sure.
Okay, to give us 100. Okay, so our revenue is, let's see. Okay, our revenue is 95,000 kwacha, like this.
Okay.
Or let me say 85,000 kwacha as our revenue. Okay, this is the
Yeah.
actual, and then you're probably wondering where I'm getting the 85, right?
Yeah.
I made it up. I made it
Okay.
up. Just like
Sure.
Zika does with their questions, they also make up figures. That's the exact thing
Yeah.
that I'm doing. Those things never
Okay.
happen. Okay.
Yeah.
All right. So yeah. Okay. So
That's okay.
revenue 85,000. I'm just trying to make a question. I'm trying to put data so that we try to solve up something, try to create something, and it gives us that understanding that we are looking for.
Yes.
Right. So we have revenue here, 85,000 kwacha. And since we are just looking at sales, I believe this information is enough. But if we were to look at a full one, like if we do the material labor variance, material, the labor, all that, then we need all the actual material cost, actual labor cost, you get it. But
Yes.
right
Yes.
now, I'm only focusing on the sales volume and the sales volume contribution variance. All right.
Okay.
So now we understand what a variance is. Variance is a difference. We understand what
Yes.
contribution is. Now let us mix the two. Let us link the two, contribution and variances.
Variances.
Okay, so let's start with a sales volume variance. Okay, a sales volume variance.
Okay.
Sales volume variance. Okay, so we bring our budget. What's our budgeted units? 5,000.
5,000. Yes.
So in the quarter, okay, change this as well. Okay, so and then we bring in our actual units, 4,500.
Yes.
So if we were to compare the two for us to find our variance, we'll notice that we actually sold less than we budgeted. We budgeted to sell 5,000 units, and we unfortunately sold 4,500 units. So we have a
Yes.
5,000. Let me put it as a negative, like this. Okay?
Okay. Yes.
It's a negative because it's an adverse. Okay? Yep. So in variances, our negatives are adverse and our positives are favorable. So we use F for favorable,
Yes.
which is positive, and we use A for adverse, which is negative.
Okay.
Right, perfect. So our variance is negative 500 units. This is in units, not in monetary terms. So we have to value it. So what do we bring? We bring the standard price. I know people who confuse this, okay? I know
Yes.
certain people might be like, okay, um, I've gotten my variance. My variance is negative 500. My variance is an adverse 500 because we're
Yes.
supposed to sell 5,000, but instead we sell 4,500. But every
Yes.
single time when I'm finding a variance of units, I need to value it. But what am I going to use? Am I going to use the actual selling price or the budgeted selling price? You get that confusion. Imagine
Yeah.
in a question you have
Okay.
two selling prices, and then you start wondering which one is which. Which selling price are you going to use?
Okay.
So it's practically a law in variances. Okay, I know there's no constitution, but I just like putting it like that. It's practically a law in variances that every time you calculate something, You calculate something based on units or usage. For you to
Yes.
value it, you need to use the standard cost or the standard price.
Okay.
By standard price, I'm talking about the budgeted price, the selling price in the budget, not in the actual. So the selling price that we are going to use here is the 20 kwacha, whether they've given us a selling price for our actual or not. But here they haven't given us a selling price, right?
Yeah.
They haven't, but you know that we can actually find the selling price.
Yeah. From our, by dividing the revenue with the units.
Yes. So we can
Sure.
divide this divided by the 4,500. So it's actually
Yeah.
18. So it's a bit less. Okay.
Yeah.
So that's the reason I was competing. I didn't want to have a massive difference. Right.
Okay. Sure.
So, and then here, the sales volume variance will be the sales volume variance will be the 5,000 units multiplied by the 20 kwacha, giving us a 10,000 adverse.
Okay.
Okay, so
Yeah.
this will be our variance. This will be our sales volume variance because we'll have to use the standard price to actually value it. But what if they want the sales price variance? Have you seen something like that in a question before, in a past paper?
Yes.
We are we comfortable with the sales volume variance?
Yeah. Very comfortable. Very, very comfortable. Very
Okay.
comfortable. Yeah.
Were you comfortable before or you are more comfortable now?
No, I'm very comfortable now. I never understood this sales volume variance calculation and how to interpret it. But this time around, I'm very comfortable, especially with
Okay,
the
perfect.
especially with the very straightforward example that you have given. It now makes sense.
Okay.
Yeah.
Okay. All right. Then now let's go to the sales price variance. So when we talk about the sales price, we are literally talking about the sales price, the price they are selling their products at. So
Yes.
that the easiest way you can use different ways for you to find the sales price variance, but the easiest way is for you to just get see I get the budget, my
Yes.
price budget is 20 kwacha, right? My
Yes.
budgeted selling price is 20 kwacha, and then
Yes.
my actual selling price is 18.89, right?
Yes.
And then the difference between the two will be uh, it will be like this. So it will be adverse in that we are selling it at a lower price.
Okay. Yeah.
Yeah. Okay. And then we bring the budgeted units. Hello.
Yes. No, I'm following.
Hello.
Yes,
Yeah.
Mr.
So we
Ronald.
bring
Yeah,
the
I'm following.
production, the units.
Yes. Units.
So we
Yes.
bring the units. The units are. Or let's do this. I want to make it simpler. Let's say we bring the actual units. We bring the actual units, not the budgeted units. The actual
Okay.
units,
Units.
and the actual units are 4,500. This is supposed to be units, not money. So let me just change this.
Yeah.
Okay. So the actual units are 4,500. So yeah, and then our sales price variance will be 1.11 times 4,500. It will be an adverse 4,995.
Okay.
Or there's another way you can solve it. You can have your budget is, we'll multiply our selling price as per our budget is 20 kwacha. So if we
Yes.
sell 4,500 units at 20 kwacha, it should give us 90,000, right?
Yeah, yeah.
Yeah, it should give us, let's see, 4,500 units at 20 kwacha. Okay, okay, all right. I just want to make sure everything is okay. All right, and then the actual, let's see if this is going to work. It has to. If it doesn't, we'll make it work. Uh, the actual is 85, meaning there's a 5,000 difference. Ah, the rounding off. Okay, it's definitely
Okay.
rounding off. Okay,
Oh,
so
yeah.
meaning, yeah, there'll be 85,000 here.
Okay.
Okay, and then
Oh, I see.
it will give us 5,000 as the difference. So let me see if I can if I round off the selling price, what it's going to give us. Let's I have multiplied. It has to be this minus this. Okay, let's say if we change this to 19, let's see, the 4,500. I think it's probably the rounding off, but it has to be accurate. But the more accurate one is this one, where we just get the price exactly the way it is.
Exactly. Yes. Okay.
Let's see, this one was rounded off, 19. Let's see, 19 times 4,500 is 85,500. Okay, let me do this. Let me say 19 times 4,500. And then we make the selling price 19 straight so that we don't have any rounding off issues. And then we see if it's going to work. Is that okay?
Yeah, yeah. Let's see if it
If
works.
we put 19 here, it will give us this. And then now we have 85,500 here.
Yes. Okay.
You say it has worked now.
Yeah, yeah, yeah. It has worked.
So
We
it
are
was the
getting the
rounding
same.
off problem that,
Mhm.
yeah. Okay, so that's the sales volume variance and the sales price variance. And now the main event, the sales volume contribution
Good.
variance.
Okay.
The sales volume contribution variance. Okay, so what
Variances.
we do when we are calculating the sales volume contribution variance, what we do or how we do it is we first define the sales volume variance, which is the 5,500. Okay, so
Yes.
our sales volume variance is negative 500.
Okay.
Okay, yeah, it's not money. Uh, Change this. Negative 500. That's our sales volume variance. And then we bring in the standard contribution.
Okay.
Okay, which is the difference between the selling price and the variable cost. So
Yes.
our standard contribution is, we calculated the contribution 5 kwacha.
Five
So we
quarter
say 5
exactly.
kwacha here. Yes. So you remember how we got the 5 kwacha?
Yes, yes. We got
So our
our. Sorry.
yeah, we subtracted selling price by
Yes.
we subtracted the variable cost from the selling price. Okay,
Exactly. Sure.
so it will be the 500 multiplied by the 5, and then our sales volume contribution variance will be 2,500. Our sales volume variance will be 10,000, and our sales price variance will be 4,500 kwacha. So now we
That's good.
calculate our sales variances.
Okay. It's
Yes.
making sense now. So, so,
Okay, so unfortunately, we don't really have enough time to finish the question. I was hoping we do, but instead we just got to explain sales variances. Hello? Hello, sir? Hello? Hello, hello, sir.
Yes, Mr. Lonadi.
Yes, sir, I can get you.
Sorry, I lost network. I was saying, I think one thing that I've also come to learn is I think the terminology is something that maybe I should also work much on, because there are times when I find difficulties answering some questions because of the terms. Where I find that maybe you do understand the, maybe the methods to use, but just the terminology, how to come up with such figures because of the terms. So from your
Yeah,
explanations, I think it's making sense now.
yeah,
More especially that we have looked at a very straightforward question, like you have done it.
yeah.
Sure.
All right, that's good. I guess I'll now have to send the link to the other group. Okay.
Yeah.
All right. So I'll stop the recording now.